Welcome, everyone. Today, my guest is Lead Analyst Logan Mohtashami to talk about jobs, rates, the Fed, and the news about Homepoint shutting down. We're also going to look back at the America's Back Recovery Model, which was published 3 years ago. First, here's a word from our sponsor. This is Sarah Wheeler, Editor-in-Chief at HW Media, talking with Matt Dowd, Vice President of Product Management at ICE Mortgage Technology, about mortgage automation. Matt, what has been the biggest challenge you've had to overcome?
Really big question. I'd say in the recent history, it has to do with the market condition and lenders' sentiment towards change in investment, right? It's really tough out there, and lenders are faced with some super tough decisions. But the market's going to change, and lenders that are willing to make changes today will ultimately be in a much better position when things turn around. Like, we can't control the market. So I believe that, as you look at automation and when you're introducing it, you need to establish trust up front and confidence in your users. So get the adoption today, get implemented, get training so that when the market does turn, you're completely prepared to take advantage of that situation.
This is so important. And listeners, you can find out more at icemortgagetechnology.com. Logan, welcome back to the podcast.
It is wonderful to be here, Sarah Wheeler, on a glorious 3-year anniversary.
It is. We are going to have a special celebration at the end of this podcast for that 3-year anniversary of the amazing America's Back Recovery Model. But before then, we have a lot to talk about. So first off, Jobs Friday.
Yes, Jobs Friday. So the headline number was good. The unemployment rate fell down. The unemployment rate for people that didn't graduate high school fell actually 1%. So that notched the headline number lower. But I think the real story is that the wage growth spiral that the Federal Reserve and a lot of people have been pushing, the entrenched inflation, we have to create a job loss recession to beat this. Wage growth year over year is noticeably slowing down for 15 months now. In a wage spiral premise, you need that to accelerate when jobs are being gained and unemployment rate is falling. That premise has been a disaster. And hopefully by now people can understand, especially the Federal Reserve, that if you're talking about entrenched inflation, your wage growth has to go higher year over year, not lower. So this explains also why the 10-year yield is where it's at, where the 2-year yield is where it's at, where the bond market never believed in the Federal Reserve members of entrenched inflation, nor other people that have been pushing that we need unemployment rates that's 6, 7, maybe even 8% to defeat inflation because of wage spiral running wild.
So let's dig in on that a little bit. So you, as part of this is what it would take for the Fed to, to pivot, to stop raising rates, to really get the message. You had jobs as a big part of that. So where are we at with the number that you've said this is where they could no longer ignore it?
So for me, at this point of the economic expansion, since all 6 of my recession red flags were up on August 5th, 2022, jobless claims data matters more than anything else. This has been the history of U.S. economics post-World War II. But for me, the Fed pivot doesn't mean rate cuts. It means the Federal Reserve will change their entire language. That's 323,000 on the 4-week moving average. What happened this week is that the government has done some seasonal adjustments to jobless claims. Jobless claims are a little bit higher than what we have been looking at. Nothing too dramatic, but definitely higher than the trends. But on a relative basis, job openings was softer this week, but still near 10 million. Jobless claims are still trailing at the lowest levels really in history. So there's no break of the labor market yet. But when jobless claims gets to 323,000 on a 4-week moving average, where job openings have been, where the unemployment rate is, the labor market is broke, which the irony of everything is that the Federal Reserve has forecasted a recession this year. And during that forecast, they're telling you they need rates higher. So, and this is why it was so painful to watch, the Fed members talk about where Mester said, I hope we don't break anything. If we raise rates too much, you broke something. The 2-year yield, the 10-year yield, everything is not going where you're at because you already broke something. So the question is, are these the people that are that far off the grid that they didn't even realize that if you didn't have emergency lending facilities done over a weekend, the city of San Francisco, and by the way, Mary C. Daly is nowhere to be found, would be in trouble. Something broke. And if you don't know that, you should not be part of the Federal Reserve. You should not be part of any labor market dynamic institution in the history of the world if you haven't realized that just occurred.
Well, and I mean, it's not just SVB Bank and other things that are broken. I mean, they've made it clear for the last year that they don't care if they break housing. And so today, we are recording this on Friday. We had news that Homepoint basically, sold off is closing down its origination business, selling off its assets to another thing. And it's like, this is just one of many businesses that have been really hurt this year in the housing industry, and they've been clear that they don't care if that breaks.
No, listening to Powell's body language and the way he talked about housing when people said, but if rates go higher, production will fall. And he's like, no, there are some apartment or commercial buildings that could be made into condos. That's such a condescending amateur answer, and it's just like, my belief has always been that the housing market is something internally that they're not very comfortable with, because they missed the housing credit bubble. We had the weakest housing recovery ever in the previous expansion. And the narrative that Americans were poor, not very educated, student loan debt crisis, everything, we're on the verge of a big price decline any year now. And then we had the biggest short-term price increase. They're not comfortable with it. So they just basically put their head down and say, okay, whatever. Housing is a recession started in June 16th, 2022, 5:01 p.m. And we're about to have the 1-year calendar. So that second calendar year is when the pain actually really starts. Because when we talk about a recession, we talk about jobs going down, incomes going down. That's what's happened in housing. Production, right? There's no more permits being issued. Permits are down, but the backlog is keeping the construction people employed, and construction labor actually fell in this last report. So this is what you traditionally see in a recession. The secondary parts would be credit deteriorating, companies going under. We're seeing that in the mortgage industry. So they don't care. They simply don't care. So don't look for that. This is a Federal Reserve that has actively opened a war against the labor market by saying that 4.5 to 4.7% is the target unemployment rate this year. And we believe that we need higher rates during that forecast. So it is what it is. My job is not to hold anyone's hand or do any marketing thing. My job is to just basically try to forecast economic cycles and housing cycles. And they made it very apparent for the last 12 months. Whatever happens in the real estate sector, they don't care right now. So that's why I said the Fed has abandoned housing. They're so worried about this 1970s entrenched inflation, even though the bond market, even though wage growth doesn't even agree with anything, that it's really clouded their judgment, and especially in the last 3 months, about what their actual game plan with Fed rate hikes, and did they break something, emergency lendings. They're kind of all over the place, and they sound confused. And that's what I see. I see a bunch of people who are confused and unsure and don't know what to do. And this mindset that growth is a bad thing. There's already people this morning that said, oh, we got to hike again. The unemployment rates are down. People are working. You don't want people in charge of the economy when they believe growth is a bad thing. Wage growth falling is inflationary, right? No, the history of pandemics have been very clear, going back 800 years. And the bond market, thankfully, everyone, happy Easter for everyone, but everyone should thank the bond market for basically putting the Fed in check, that there was no 1970s inflation. The 10-year yield would be north of like 5.25%, even 8-9% if there was. Fed funds rate, 2-year yields would be skyrocketing. They never have. So the bond market is very pro-American labor. The Federal Reserve is not. So the best thing I could tell the audience listening, that thankfully the bond market is smarter than the Fed, and they are not old and slow. And that's been a good thing this year.
Let's talk about mortgage rates. So you've talked about the 10-year and the bond market, what it's doing. Exciting news too. The HousingWire has the Mortgage Rate Center, which we've had for a while, but we just upgraded it. And we have this amazing new input from Optimal Blue and some other things that are much more real time. And so everyone check out the HousingWire.com Mortgage Rate Center. It's amazing. So Logan, where are we with mortgage rates?
Well, mortgage rates should go up a little bit today. The bond yields, the 10-year yield, it's a holiday trading day. There's no stock market going on, and it's a Friday. The bond market closes early. So don't take anything too seriously, but today's action. But mortgage rates should go up a little bit. But, in theory, we should be at 5.25% today if the spreads were normal. But the 10-year yield, again, the whole 2023 forecast was 3.21% on the low end, 4.25% on the high end. Mortgage rates between 5.75 to 7.25. That was a range. So far, that range has stuck. If the labor market breaks, we should break under. What's occurred is, again, the banking crisis has now pushed the bond market to think that the recession will come faster just because of that. So a good week on mortgage rates and coming down, but today most likely pricing will go up a little bit. But again, we were at 7.37% toward the second half of 2022. We got down to 5.99 once. We're heading lower. Labor market gets weaker. The bond market should break. That's slow dance, right? The reason I wanted everyone to think about slow dance is that the 10-year yield matters more than anything else. And if that starts to occur, you don't get higher bond yields when wage growth is cooling and the labor market gets weaker. That's not the 1970s inflation could make a case about that in the mid 70s and the early 80s, but we don't have that because the 2-year yield's already breaking down. The 10-year yield isn't really breaking out. So be grateful for that, because if you had a 1970s kind of inflationary, the housing market would be in a lot more trouble than anybody could imagine, and it's just not here. So I would let people know that rates falling down this year, not a surprise, and wage growth on a year-over-year basis slowing down since the early part of 2022 are positive housing stories going out in the future, because it really shows that 7.37% mortgage rate could have been the top of the cycle because the things that are really driving inflation rates have been slowing down for some time now. And if you just get the spreads anywhere back to normal, you got mid fives or low five handles just like this. But the mortgage-backed security market is still stressed.
Right now we're in the low sixes, like 6.2, something like that. Again, you always say, it's not like that's the headline number. That doesn't mean that's what you're getting when you go. You might be getting something, a consumer might be getting a much better deal than that.
Yeah, that's a good conversation that doesn't really get talked about. What is the final lock rate? Because people are buying down rates and so you get seller concessions. So to me, anytime you're near the 6 level, you're always going to have a 5 handle for a lot of people that can push it down. So that's why I said that 7.37 and higher, very problematic in the housing market. And now definitely we just had one of the biggest month-to-month sales prints in history, right? It's why, because mortgage rates fell. We had 12 weeks of positive forward-looking data, and buyers were there. So millions and millions of people are working. We're almost the non-farm payroll is almost over 156 million. So mortgage. The housing cycle doesn't need like 15 million mortgage buyers a year, right? Roughly just needs 4 million, and then you have cash buyers or anything. So that's why we saw that big rebound in the month-to-month sales, because the waterfall demand collapse. It's not a demographic story or a credit getting tighter story. It was just an affordability issue, and affordability got better and demand picked up. And that's why some of the markets we're seeing right now, people are saying, oh, there's too many multiple bids. Well, total active listings are still all-time lows, and we didn't get any seasonal inventory push just yet.
So that perfect segue to the next thing I wanted to talk about, which was inventory. So we are talking about this. We're recording this on Friday. This will be published on Monday. And by that time, we will have the housing market tracker up, which is where you look at 10-year yield and mortgage rates, purchase apps, and inventory to give sort of a holistic view of where we are. What do you think? We have been saying this now for weeks and weeks, and maybe even a whole month, is like, where is the bottom and where do we start getting some seasonal inventory?
So this data this year looks a lot like 2021. 2021, the weekly inventories were actually bottomed out in April and they started to rise. So we've always had seasonal inventory increases. Even in COVID, we had a very brief seasonal increase. And then, of course, COVID-19 changed a lot of behavior and demand picked up. So we should get the seasonal inventory push. That would be very abnormal. The new listings data trending lower and lower, all-time lows this year, is problematic in the sense that there's just some buyers that just go no, not yet, and the new listings data has been trending lower for many years now. That story has been here. This is one of the reasons why I'm not a mortgage rate lockdown person, but um, it'll be interesting the month of April. April, how I look at purchase application data, the seasonal shift is the second week of January to the first week of May. So April's always a very big month for me. After May, total volumes traditionally always fall. We haven't had a traditional purchase application data year post 2020 at all. So it'll be interesting to see that if rates do go lower in the second half of the year, if let's say the labor market does get weaker, do we see it will be the fourth year of purchase application volumes getting better toward the end of the year and then pushing out the seasonal bottom again in 2024. So yeah, this is going to be a very, very fascinating month in the housing market, just because rates have fallen, purchase application data has gotten better. This year, we still have more positive prints than negative prints, and the seasonal inventory buff has to happen. I mean, if it doesn't happen in April, and we're now going to May, you're really getting into some historical factors here. But 2021 was April, so we're just going to go with that and see what happens.
It just feels like the window is shrinking. That's such a small window. We're in April. If it's the end of May or mid-May when we stop seeing that, like, that's not a very good purchase market, and we desperately need that.
It's one of these things. 2021 was April, and then also in 2022 March was the bottom. What we traditionally see is that the inventory bottoms, single family listings usually bottom out in January, and then February, March, and April. Then you see the increase. We don't have that anymore.
So I think it's interesting that you said something about like the fact that whatever happens, if we have more inventory come on in the, if rates go lower and then more people list their homes in the fall, that has the knock-on effect of pushing out the spring home buying season later, which I just didn't think about before. But like if rates fall, then maybe we have a hope of like it's going to be a September, October story instead of an April, May story.
Well, we could talk about it in this light too. While new listings data was at all-time lows, we just had one of the biggest month-to-month sales prints ever. So demand is, people list their homes and then, you get a quick purchase. Doesn't necessarily add to the active listings, just because the active listings are days on the market in inventory growth. So some people are confused about that. They're like, if inventory is so low, how do we have such a big sales print? Well, you list your homes, you get an offer right there, you sell it. That inventory doesn't hang in there in the active listings reports. The NAR has, holds the pendings, and that's why that number is traditionally higher than other inventory. But to me, this story has been here for many, many years. And part of it is that people just live in their homes longer and longer, and you can't freely list your house like you did in the early part of the century, just because back then you didn't have to worry about rates so much. The loan product allowed you to list your homes, and you could buy something. The whole housing dynamic has changed after 2010. If I had to do just one thing in my life, one dissertation, it would be that the mortgage rate lockdown is not a real thing. It's credit channels.
Calling all mortgage, title, and insurance leaders. With interest rates shutting down your refinance business, your relationship with your real estate partners is more important than ever. HW Media wants to help you deepen relationships and find success in this competitive purchase market by inviting you to attend Gathering of Eagles. Real Trends Gathering of Eagles is the real estate industry's premier event, bringing together leaders from the most successful brokerages in the country. For the first time ever, this closed event is open to our full audience. Check out the show notes to find out more, or head over to realtrends.com to purchase your ticket today.
And I would go to the grave with just that one, just because what people are so accustomed to is the early part of the century when sales were booming and inventory was rising. And that was just a completely different housing market, different kind of credit channels and structures. And now everything's legit. I mean, you when you list your house and you're looking to buy, you know that you're qualified and looking, and you're just dealing with when do you sell your house and buy another one. So there's a whole dynamic there that it's really a longer, more complicated story that nobody wants to talk about. Everybody just wants to say mortgage rate lockdown, mortgage rate lockdown,
Well,
lockdown,
those of us
lockdown.
those of us who think about the mortgage rate lockdown think there are some other factors, some other
This
variables
is actually something interesting. There was an article about all these poor people that said, I'm locked in my house. I bought a house in 2021, and I'm like, dude, you're not moving. People are sitting in their homes longer and longer. You're not moving. You usually people stay in their homes 10, 11 years, and we're trying to make a kind of a new variant economic theory that somebody who buys a house in 1 year wants to move the next year or 2 years from that. That's not the case. Mortgage rates were 3.25% to 5% during the longest economic expansion ever in history. So we got as low as 2.5 to 2.75. There's whenever rates fall, it does not actually create active listings to grow post 2010. I encourage everyone to go see the data. The only two times we saw active inventory grow was 2014 and 2022. Both times purchase application data is adjusting to populations hit an all-time low. Sales fell. Days on market grew, active listings grew up. But how you look at inventory channels going back to the early 1980s, there's a reason. A seller is a buyer. The inventory kind of gets washed. If the days on market grow, weakness, you could have active listings get higher. But mortgage rates falling and inventory rising, not really a thing in the last 13 years. Mortgage rates rising, demand gets weaker, days on market grow. Yeah, you can make a case there. And we have 2 years now in the last 13 years to show that to be the case.
So one of the stories that I'm seeing pop up in different places is that people who bought a house and they have this really low interest rate. If it's like a second home or whatever it is, then they can rent out that house because, it's more advantageous to them. They have a low rate, they have a low payment. So there's going to be more rental income, but less houses for sale. What do you think?
Traditionally, people don't let go of their house unless they have a reason. And now more than ever, I kind of make a joke about this, that people have really, really low housing costs versus their total wages. So why would someone go homeless with that? No, once you let go of that house, you lose that. The greatest hedge right now on planet Earth is a 30-year fixed mortgage that the United States of America has, not other countries. So in the real world, where people actually function normally, they don't think like crazy people. Crazy people said, oh, everyone needs to sell and get out. And, that's just not how the functionality of housing is. But again, even with all that, when rates fell, guess what happened? Housing demand picked up. One of the biggest month-to-month sales ever, and new listings trending was basically where we were in 2020, 2021, and 2022. So inventory, I think, is a little bit more complicated of a subject. But the headlines are like, these poor people and their 3% mortgage rates. Boo-hoo. Oh, let me feel bad for them. And people are moving every year, right? People are moving this year. People are listing their house every week. Sarah Wheeler, there's thousands of people listing their homes, right? And there's also 42% of homes in America don't have a mortgage, right? There's more, there's so much inventory that's not in a mortgage rate lockdown, and then there's people listing. So it's more complicated than just the rate variable. But again, demand gets better when mortgage rates fall. Demand gets worse when mortgage rates rise. It sounds very simple, but it's true. Just kind of go with that. Credit getting tighter, not really a thing post 2008. We wrote about that recently, but so the labor market is still good. Millions of people are working, over 155 million. And if rates fall, you can get more buyers in that sense. And remember, not everyone sells their house to buy another house. You have, first-time home buyers don't do that, right? So there's more to the story than meets the eye.
Okay, let's talk a little bit about Homepoint. We'd heard rumors for a couple months that this might happen, but sad for us to see Homepoint to shut down originations and it's selling its assets to the loan store. What do you think about that? How does that play? How does that reflect what's going on in the market right now?
Housing went into recession on June 16th, 2022, which means that the longer the recession goes, the more painful it is for those in the industry. I think that's the 12th lender that has gone under since that point. So you have a sector that has a lot of overcapacity, and you have basically margin wars going on everywhere else. Those two things, with a smaller pie, not good for businesses. I mean, you have a lot of intense competition for a smaller demand curve. So traditionally, going into the second calendar year of a recession is when you really to see more and more of the pain. I mean, think about if the U.S. was in a recession for over almost a year. The longer it goes, the more credit stress you see because people just don't have enough income to pay their payments. Delinquencies start to rise, stuff like that you traditionally see in a recession. And we're in a sector that the Federal Reserve doesn't care. And that's, once the job loss recession does occur, bond yields will go down, mortgage rates will go down, business demand will pick up. But from here to there, from that June 16th day in 2022, you can see the damage that's being done in the industry. And then if you ask the Federal Reserve, they're just like, housing's weak. Okay.
So crazy.
Brilliant observation.
You
I
broke
mean,
it.
it's interesting. I mean, the spreads if they got better would actually help the industry. And this is actually one good point, and probably the main point of today. Yesterday, James Bullard, our favorite Fed person, talked about, well, if bond yields go lower, it'll help offset higher rates. So people don't understand that concept yet, but there's some truth to that. When I write that the Federal Reserve, when the 10-year yield starts to go lower, it does some of the easing for the Federal Reserve. The one sector that's in a recession is tied more to long-term bond yields than short-term. So whether the Fed cuts rates is irrelevant. It's where the 10-year yield goes. So we've seen demand pick up while the Federal Reserve has been hiking rates, and doing quantitative tightening or in that sense because the 10-year yield has fallen. So that in itself, if it keeps on going lower and lower, the Fed in their back of their minds, you could see they're already having this discussion. The one sector is in a recession is housing. What they need to do if they really want to believe in that is not do what Neil Kashkari did on CNBC, where he goes on TV. Oh my God, 6% mortgage rates. That means people are buying homes, they're having sex, and then they're going to have kids, and then they're going to buy more stuff. We can't have that. You can't do that act anymore at this stage. We've front loaded so much of the rate hikes because the whole point was to stop and have the lagging impact hit in, not to raise rates and then all of a sudden freak out when you see a growth still going. So they're confused, Sarah. They're just confused. They're all over the place now. They don't even realize there was a banking crisis. I mean, they literally Mester went on national TV and said, higher unemployment rates need to go higher. Wage growth is already cooling down. You'll see that in the article that will come out on Friday. So they just can't take the victory. They are old and slow.
They're old and slow. Well, I hate to see another lender go under, and we hope that more don't. That's just terrible for our industry. But I did want to end today's podcast talking about something that happened 3 years ago today. We talked about at the beginning, and that was you wrote something called the America's Back Recovery Model. And it was really singular and stellar. So 2020, 3 years ago, we were right in the middle of COVID, and it was scary. Like nobody really knew what was going to happen. It was a time of like shutdowns and, people working from home, which now so many of the things that we do now that seem so normal were just brand new back then. And there was a huge sense of fear and pessimism, except for my friend Logan Mohtashami And so to commemorate that day, for those of you who are listening, I got a birthday cake, or maybe it's an anniversary cake. I don't know, but this is worthy of celebrating because it was such a pivotal point for you and for HousingWire, and also just for, people to understand what was happening. You made a call that was very controversial at the time. We had people who were like, why should you really publish this? It's a pretty big deal. So tell us what happened 3 years ago today.
The America's Back recovery model, what we had in the previous expansion is from 2010 on to this year to date, we've had so many recession calls by Wall Street and by economists, and none of them worked, right? Because what I see is a bunch of people that don't actually have models, right? So if you don't have a model, you're just making stuff up. So what happened on April 7th on that day was the St. Louis Financial Stress Index was already recovering, and the 10-year yield was above 62 basis points. Now, I don't want to make this super complicated or nerdy, but because those two things were there, that was my trigger date for the recovery of America in 2020. Now, of course, back then, as you can imagine, bombarded by you're a lunatic, you're crazy, you're a perma bull. I said, no, we have recession. Anybody who believes in models cannot be a perma anything, right? Stock traders can just make up stuff all the time, but people who believe in models said, okay, on this date, we're going to start the recovery. We're going to give people certain data lines and dates. We talked about May 18th being very crucial. We're talking about during that year, by June, June 15th, you're going to see housing data recover, because household balance sheets were good going into this recession, which is still my talking point today. The demographics are much different. We are going to have a recovery. And by the end of this year, the final thing was on December 9th. December 9th, the 10-year yield got to almost 1%. It was like 99 basis points. I said, okay, retired. Everything of the recovery model actually connected the dots. If you have a proper model, you connect the dots, you could see the recovery. And the thing was that nobody believed the recovery too. Everyone was like, oh, something bad's going to happen still. L shape, K shape, whatever shape. Garbage, right? The post 2008 to 2014 economic takes were garbage, because it became sexier to be an extreme left-wing or right-wing political economic theory person. And I hate political economic theory. I thought it was garbage. So you have to show people models to do this. And if it didn't work, then my whole economic model thing would blow apart. But it connected the dots, because we want people to be the detective, not the troll. So then during that whole expansion, we're just updating it and telling people. And then
during what whole expansion?
During the year of 2020, the economy bottomed. Then after April, every single year was growth. It was the fastest, greatest recovery we've ever seen in U.S. history. But you have to keep going, right? You have to keep tracking data every single month, every single week. So you give people an idea how this works. And I know it seemed crazy because people were stuck in 2008, right? So even when we talk about the jobs report today, right? If we didn't have COVID, we should be like 157, 158, 159 million around their jobs. So some of the labor is just still in makeup demand. It's confusing because the Fed tells you that nobody wants to work or whatever. We can't find workers. We have 166 million people that are in the civilian labor force. The people that aren't working really are like part-time people 70 and over. Like that labor market hasn't recovered. Okay. Like the biggest pool of labor. All right. I think we'll be okay. So in that context, all the pathological lying that happened after 2010, about 96 million people are out of work or everyone's a part-time worker. It's never. So for me, and to be honest with you, Sarah, this is the only reason I'm writing. It started in 2015 for me. We have to destroy as many American bears until they are dead, until I'm dead, right? So their children and their spouses and their family relatives could see them for who they are, pathological liars. And then from that, explain to people how to look at economic models and how it really works in the real world. And then when you can teach that, and then people will know themselves, right? And then they learn, and then they realize that they don't have to be manipulated anymore. And that was the whole, I mean, that was it. I mean, everything had to really work on that America's Back Recovery Month, because we weren't going into a recession. A lot of people thought in 2018 was the housing bubble crash, or 2019 we were going into a recession. I think I tagged you with some of the videos on my memories section. In Christmas Eve 2018, people thought, oh, the recession's already started because the stock market was down 20%. No, none of my six flags were up even in the previous expansion, but now they are. And we believe in progression economic models and teaching people. So the best way to fight fanaticals is to teach education, because traditionally fanaticals don't read, right? That's the history of human civilization. There's this group of people that don't believe in reading or anything like that, and they can manipulate people. We, on the other hand, believe in math, facts, and data, but we have to teach it. And if I had one criticism of the macroeconomic world, is that the economists out there don't realize how much bad information is out in the public, because this is modern day warfare, right? And people go on social media and lie all the time. And my job is to basically teach models. And that's really the only reason I hear it. I mean, I was ready to tell Clayton, I'm giving my 30 days because America Back is retired on December 9th. And that's all I really wanted to do.
And this is in 2020.
Yeah, this is in 2020. I was gonna be done writing. That was it. But then I was thinking, the forbearance crash bros, what is this? And I realized these people will never stop, right? They will never stop. Darkness never, ever becomes the light, right? That's the internal battle. So some of us have to always stay in here and try to teach people, bond markets, mortgage rates, economic cycles. And it's not the sexiest thing in the world. Trust me. It's not very, it's easier to do the other things, but that's literally why I'm here every day. That's why I look at economic data all day, all night, and trying to teach people in the real estate and the mortgage industry how economic cycles work, what they should do about it. And that's why we do the dancing thing, right? Let's 10-year yield, mortgage rates, dancing together. Lovely couple. They can drift apart a little bit while they're dancing, but they're slow dancing all the time. And in that way, we could explain what drives the bond market, what drives mortgage rates. And a lot of the fear, and partly the Federal Reserve's talked about entrenched inflation and, the mortgage rates going above 10% or something. No. So that's why we do it. And the America's Back Recovery Model was ground zero of trying to explain why economic models work and they matter. And you got to listen to people who forecast. If people aren't forecasting with their name and face, my rule, Sarah. They are cowards for a reason, and they do not want to do what people have traditionally done for thousands of years.
I think 2020 was the peak of the housing, what you call the housing bubble boys, who were just calling for it constantly. It was one of the most searched things on our site. Housing bubble housing crash 2020, what was going to happen. And so we were really happy to have you on. And crucial to your work is the 10-year yield, which not a lot of people talk about. They talk about mortgage rates, but not the 10-year yield. And so that's why you created the housing market tracker. And one of the things you track is the 10-year yield, because that was one of the things that showed you in that time what was going to happen. It's one of the hallmarks now that you look at.
Yes, and I started, doing 10-year channel work in 2015, and from like 2015 to 2020, literally it was the same forecast. We're going to be in a range between 1.6 to 3%, 3.25 to 4.75 mortgage rates trends. It was really only in 2018 that long-term range was actually challenged, and 2019 said rates are going to go lower. Even talked about a one handle, sub 4% mortgage rates in 2019. The only person on record, I think, I know the Wall Street Journal had like 50 economists, everybody had rates up. But if you look at the 10-year yield chart and stuff like that, you could see what's going on. COVID-19 put a huge, variable changing thing in history. I think tracking high velocity data is complicated, but we try to do it as best. So that's why the tracker was created, just so people can understand. But the 10-year yield matters, credit matters, demographics matter, right? I'm a demographics person, right? years 2020 to 2024 has the biggest housing demographic patch ever recorded in history. That was in the census. That was in there for people to read for decades. It was there. These people just don't disappear, right? This isn't like the Logan's Run book where everyone dies at 21, right?
It was 30,
there.
right? It was 30.
30 was the movie, but the book was 21.
Okay. See, I didn't know
forget
that.
about that, right? The book, you died at 21. So yeah,
21.
I think that was a little bit too grim for a movie, so they made it at 30 because the actors could be all teenagers. But these things matter, and I know it's not exciting. Trust me, I am trying to make economics as entertaining as possible.
Which you do, yes, which you do. So we just wanted to say thank you so much. I will be eating a piece of this cake by myself. Thank you so much for giving me this opportunity. And thank you, Logan, for being on and not quitting at the end of 2020, your writing, because I feel like it's super important, and just want to say thank you.
You're welcome. And it wasn't quitting. It was just retiring. I was only going to write for one cycle.
Yes.
But
listen, your basketball coach and you're like, don't say quitting. That is not quitting.
No, don't say quitting. No. But if anybody wants to kind of have an idea, we'll tag the final article of the America's Back Recovery Model, and it amazed Wall Street. There was like a 90-minute podcast interview with a Wall Street person in that link, where we just literally go over point by point what happened, because it's not the final answer, Sarah. It's the why. Because if you understand the why, then the whole world opens up to you. And that's the beauty of math and numbers and everything. It's just that it can all connect the dots, and that's why models are really needed. And then you could make sense of a lot of the things that are happening.
I love it. And we will continue to tap that insight and wisdom. Logan Mohtashami, have a great weekend. Thanks for being on.
Happy Easter, everyone.